Hello, this is Ann Jones, Webcast Manager at PRMIA, and I am pleased to welcome you to this PRMIA webinar brought to you through the generous support of New York University Stern School of Business. Today, Professor Roy Smith will present the future of global banking. Roy C. Smith has been on the faculty of the New York University Stern School of Business since September of 1987. Prior to assuming this appointment, he was the general partner of Goldman Sachs and Company, which he joined in 1966, specializing in international investment banking and corporate finance. Upon his retirement from the firm to join the faculty, he was the senior international partner. During his career at Goldman Sachs, he served as the president of Goldman Sachs International Corporation, while resident in the firm's London office in the 1980s. Professor Smith received his BS degree from the U.S. Naval Academy in 1960 and his MBA degree from Harvard University in 1966. Please feel free to submit your questions to the presenter via the question pane on the right-hand side of your screen at any time during the presentation. Audience questions will be moderated by PRMIA's Training Director, Alex Voicu, and answered by the presenter at the end of the session as time allows. Following this webinar, a link to the presentation will be emailed to you along with a link to the recording of today's webinar. So now, Professor Smith, I will turn the presentation over to you.
Okay, thank you very much. As you can tell from the introduction you just received, I'm one of these old guys who have been in this industry for a very long time, about half of it spent as a practitioner at Goldman Sachs and the other part spent as an academic trying to understand what goes on in this industry. So I'm happy to share what some of my observations are about a very critical subject, which is what really is the future of this industry, which has been so beaten up by the cataclysm it's just been through. This program is provided to you by NYU Stern Master of Science and Risk Management Program, which you can see from this slide operates in 3 locations, New York, Hong Kong, and in Europe, and provides a degree, a Master's of Science degree focusing on the risk that corporate boards have to deal with. And that's kind of one of the subject matters for today. So let me go on and say that in order to determine what the future of global banking is going to be, we have to have some idea of where we're coming from. It's hard to know where you're going if you don't know what you've been through and such to get to where we are. Obviously, starting in 2007 and 2008, we had a cataclysm in the international financial system, which affected the large global banks more probably than anything else. This was indeed a systemic failure. It wasn't almost a failure, it was the real thing. And it collapsed markets and institutions all over the world, resulting in market responses which shut down markets as the liquidity drew out of them. And as a result, regulatory agencies had to step in to figure out ways to respond first to liquidity issues and second to the structural issues that affected the industry so that this stuff wouldn't get repeated again. But here we are today, really 5 years after this whole thing began, a period of time longer than it took to the United States to get into and fight and win World War II. We are still facing 3 separate problems from the standpoint of the global banking industry. The cyclical downturn that has suppressed profits, the structural changes that were made by the regulatory things, and some serious damage to the reputational features of this industry. This is a picture of the economic Pearl Harbor, I suppose. This is the real Pearl Harbor, but Warren Buffett described September of 2008 as an economic Pearl Harbor, and it kind of had this effect. These are the pictures of the battleships on Battleship Row in Honolulu, December 1941. I guess you might say the first one you're looking at looks like Citigroup. The one over here is Bank of America, Merrill Lynch, and others. So let's take a look at the systemic failure that we did have. It was really created by a run on the financial system liquidity. Asset prices dropped well below the expected default values as investors began to be frightened off from mortgage-backed securities, many of which had a high content of subprime material in them. This was, of course, after several years in which real estate prices had been rising in the United States and other countries by double-digit numbers. And this turned around in late 2006 and began to be appreciated more by the market in 2007. But the avalanche didn't actually occur until almost a year later, in September 2008. But during 2007 and 8, massive write-offs had to be taken by banks as they marked their positions to market. Many CEO changes occurred. And the regulatory response essentially was to follow the basic too big to fail policies that everybody assumed that they would be following. Now, there are some exceptions. The major exceptions were Lehman Brothers, but also Washington Mutual was another. In the case of Lehman Brothers, people were quite surprised when it failed and was allowed to fail in September after Bear Stearns, which had been a smaller investment bank than it, was essentially rescued with a $30 billion government guarantee, Federal Reserve guarantee 6 months before. After the Lehman unexpected failure, the markets simply panicked in all directions and all remaining liquidity disappeared. Looking at the casualty list from that time, we can see that Fannie Mae, Freddie Mac, AIG, General Motors Acceptance Corporation, Royal Bank of Scotland, Citigroup, Bank of America, UBS, Lloyds, Commerzbank, Fortis, many others, all really hardly survived this. They were so badly wounded they would require major efforts to get them back. Some disappeared altogether. Bear Stearns, Lehman, Merrill Lynch, and Wachovia were all taken up into mergers to rescue them. Washington Mutual was essentially taken over by the FDIC and resold to J.P. Morgan. But as a result of all this, the 5 standalone investment banks disappeared. Lehman was bankrupt and broken up and sold. Bear Stearns, Merrill Lynch were rescued by mergers, but Goldman Sachs and Morgan Stanley became bank holding companies that were no longer considered just investment banks as they had been before. Now, the effect on the real economies of the world after these financial collapses was very acute. In the fourth quarter of 2008, the first quarter of 2009, the U.S. GDP dropped in both cases on a year-on-year basis of 6%. This was as great a quarterly drop as we probably ever had. The official dates of the recession were that it began in January of 2009 and ended a year later, but what has been called by economists the Great Recession has lingered ever since, and we're still really kind of in it. New investments have declined. As a result, the U.S. GDP has grown only at an average rate of 1% for the last 5 years, which is really quite a very unsatisfactory rate for the United States. Fiscal deficit in the U.S. rose to 10% of GDP. It's improved a little since then, down to only about 8%, but it should be about 3%, so we're way out of line on that. Unemployment rate, has risen to 8%, now it's down to 10%, back down to 2%, but still about twice the pre-crisis level. And all of the problems in the U.S., as acute as they may seem to Americans, are much worse problems being experienced in Europe, as most people know. The U.S., the Economic Union and the ECB have announced $1 trillion in support plans, which are being deployed rather slowly. Many political problems getting all this resolved, but in general, the economic effects of the crisis are in Europe far worse than they are in the U.S. Now, the governments have intervened extensively to try to address these problems. First, the USA, we produced something called the Troubled Assets Recovery Program, involving several rounds of assistance to Bank of America and Citigroup to keep them afloat. There were about 400 banks that participated in this round of the TARP programs, which amounted to about $450 billion altogether, most of which has now been repaid. The Federal Reserve supported the liquid markets to extraordinary extents. The balance sheet doubled during the crisis, but the infusions of money from the Federal Reserve have been estimated by a Bloomberg report to be close to $8 trillion during this period. This is far and above any level the Fed had ever achieved before. So this is really a major effort to pump it up. They also provided a stimulus package for the economy, auto industry assistance, and so forth. And even so, with all this efforts, we still haven't got past 1% annual growth rate. In Europe, similar stimulus programs and support efforts were made, but it has busted the budgets of balance sheets of most of these sovereign states, so they have also expanded greatly the amount of borrowings that they have. And China had a major stimulus program, too, to offset the decline in orders from the U.S. and Europe. Here's a picture of the Federal Reserve's balance sheet. It shows that it goes up to somewhere around $2.25 trillion at the top, but you can see all these different asset classes were being bought by the Fed during this time to support it. And, of course, in many occasions, the stuff was bought and sold many times during the year, which is how we get to $7 or $8 trillion of total support. Now, at this point, I'd like to ask the first of the poll questions. The worst financial crisis since the 1930s, and its after effects are now largely behind us. Do you agree or do you not, 5 years after the crisis began?
Anne?
Yes, I'm hearing that too, Andrea. I'm looking.
Yeah. Can we launch the poll question?
Yes.
I just read it. Shall I?
Yep, you're fine. Nope, just hold on a second. I have launched the poll question. You have 10 seconds to answer. I have closed the poll question, and the answers are 27% agree and 73% disagree.
Well, that's probably the right answer, because although you could say that the markets have been stabilized and they aren't getting a whole lot worse, and we're not being about to plunge back into another abyss, notwithstanding the fiscal cliff negotiations going on in U.S. Congress at the moment. The after effects of this crisis are continuing with us. It's a long, long slog to get this behind us. It's going to have profound effects on the institutions which are in this industry. So let's go on. We talked about how we got up to this point. Who are the global banks that we are referring to as being the principal institutions to be affected by all this? This is an effort to create an impression of the most important and influential global capital market banks by taking 4 different categories of things that they do, measuring them by full credit to book runner or its equivalent, and adding them up across the line to get to a total. So we start with global debt, equity, M&A advisory, and bank loans. They add them all the way up to come up to the sum of the so-called, this is a measure of the shoe size of these people in the market. So you can see that for last year, J.P. Morgan had about 11% share of all the transactions that were done. The top 10 of these, going all the way down here to BNP Paribas, represented about 70% of the entire market. This, by the way, is down from a number close to 85% 5 years before. And the top 5 have 43% of the market, down from about 55 before. Now, below the top 10, you find the other suspects and the leadership of capital market players. But all of these top 20 are the principal ones about which we will be speaking, but with the principal emphasis on the top 10. Now, of these top 10, the crisis was sufficiently severe that they had to write off $605 billion of their capital. For many banks, this was all of their capital. And others, it was a very significant portion of it. You know, the Bank of America and Citigroup would have probably gone into some kind of federal takeover of the bank or the bankruptcy equivalent if they hadn't been rescued twice by TARP. UBS actually did fail. Barclays was rescued only by big investments from some sovereign wealth funds. And the The rest of them had to take off quite a bit of losses, which they had to replace by raising capital in this period. So they almost raised as much as they lost in the 2007 to 9 period. Subsequent to 2009, they probably raised another 100 billion or so they're back up to having covered it all. But now they have to, of course, raise higher levels of capital because of increased standards. Now, the regulators came in with new rules right after these losses became evident. Basel III is the name of the third version of the Basel Agreement, initially made in 1986, that went into effect in 1992 among about, I think initially it was about 10 countries whose central banks agreed to impose the same standards for minimum bank risk-adjusted capital adequacy. That number of countries had signed on is now 27, and this is the third iteration of the Basel Agreement. Although remember, the Basel I was intended to be a way of deterring financial risk from reaching systemic proportions that could create a systemic crisis and a failure. Obviously, that didn't work. We've been through 20 years of creating efforts to manage systemic risk, and it's failed. But now Basel III is an effort to make it right this time. The G20, the group of 20 major economic powers, countries, has set up a financial stability board, which was originally chaired by Mario Draghi until he got a new job as the head of the European Central Bank, and now it's being chaired by Mark Carney, who's the governor of the Central Bank of Canada, who has been hired to be the Bank of England governor. Dodd-Frank is the U.S. legislative response. European Banking Authority is a new organization, a new institution created to regulate banks by the European Union. So this goes beyond the Eurozone to all of the 27 European Union countries. The Swiss finish is a parliamentary action by the Swiss government in response to the great indignation that the Swiss felt at having to bail out UBS, which it did with government money. And so the Swiss finish means that after you have already taken care of the requirements of Basel III puts on you and so on, the Swiss will have a finish off requirement that increases it to an even higher level. Vickers Commission is the name of a British commission appointed to recommend ways to reduce systemic risk in Britain, where the top 4 banks have a total amount of asset exposure that is something like 4 times the size of the GDP of Britain. So they wanted to make sure they were not insuring with taxpayers' money risk exposures that were far greater than their own economy. And finally, we have been in discussions within the European Union to create a banking union, which may be limited to the Eurozone, but they're hoping to get the entire European Union to enter into this thing, which would be controlled and governed by the European Central Bank. Starting with Basel III, minimum risk-adjusted capital adequacy standard for banks, 2 changes were made. One is that they increased the amount of capital that would have to be held in Tier 1. There are 2 tiers, which add up to the total capital required, but Tier 1 is basically equity capital. So they have increased this by steps, starting now in 2013, to get to 2018 to a level of 6% in Tier 1. That's going from originally 4% to 6%. But the risk definitions of what is being used in this calculation have been changed. The Tier 1 capital is the equity capital divided by risk-weighted assets of the bank. The risk-weighted assets have been redefined so as to be more stringently calculated, and therefore you have to have more of your assets will be risk-weighted assets, and you have to have more capital in proportion to the risk-weighted assets than you did before. The total capital for Tier 1 and 2 will add up to somewhere around 10.5% by 2019, but the Financial Stability Board of the G20 is requiring up to an additional 2.5% of Tier 1 capital for systemically important banks. This is called the Basel 2.5, but it means that banks like J.P. Morgan would have to, whatever the final outcome for Tier 1 would be, they have to add 2.5% to it. Now, the Basel Agreement also talks about a liquidity coverage ratio, which is capital to meet 30 days of possible standby calls, to be introduced in 2015. The metrics of this haven't been set yet, nor have they for something called the net stable funding ratio, leverage restrictions, to be introduced in 2018. Now, when you look at this, the Basel, over here is the Basel III capital ratio that the banks have now. They're somewhere around 6% on average, you might say, a little 6.5%, and they have to go higher. But for the most part, the banks have moved already to adjust their balance sheets to provide for the level of capital that they need in the future, because shareholders, counterparties in the trading markets, and trading rating agencies have essentially said that unless you do so, we won't regard you as financially solvent. So that's forced the liquidity of banks to drop from a gross level of 35 or so well back in the crisis, before the crisis really hit, down to a level about 15 or a little more, where it's being maintained for this time. So this is an effort to deleverage, and that deleverage has been almost 50% in these banks, and that's caused a big adjustment to the balance sheets. What Basel III is going to require is that whereas this might be the total assets of the bank, in the past, Basel I might have calculated that about 45% of those assets were actually risk-weighted assets that you had to provide for. Under the new arrangement, this will increase by 56% to something close to 70%. And bank management will make efforts to remediate this by adjusting what assets they hold so as to hold ones with less capital requirement. And they think they'll be able to get something like 11% back down from that. But still, you can see that when it's all done, the total amount of risk-weighted assets as a percentage of the total assets will increase considerably. Under this arrangement, it's going to be very hard for any bank or trading body subject to these rules to maintain leverage ratios in excess of 15 times their current assets with their current business mixes. That means that much of the trading profit history of these banks was dependent upon greater levels of leverage, which will not be with them in the future. Dodd-Frank, you know, has had a huge impact on the regulatory situation. It was passed in the summer of 2010. It's a huge bill, 2,300 pages, 15 sections, only one of which relates to systemic risk, by the way. According to the bill, they estimate it to cost about $20 billion to implement it. Just that's the government cost to implement it, not to mention the cost paid for by everybody else. But it creates a new regulatory command structure in which the Federal Financial Stability Oversight Council will be the sort of the leader of a group of 8 regulators who meet as a council to essentially approve regulatory policies. The whole idea is to try to eliminate the systemic risk amongst those banks that otherwise might be thought of as too big to fail, or systemically important is now the term we use. They're going to have those banks require more capital, but they haven't required that the banks be broken up. That was a big issue. There's also the Volcker rules, which will prohibit proprietary trading and other investments, and other factors will make the bailouts much more difficult in the future than they were in the past. That's going to create a consumer financial protection agency and address various other things, including derivatives, compensation, and so on. This is one view of the organizational complexity of this new bill. All of these things seem to regulate everything else, so it's a big mishmash of how it's going to work. Only about 40% of all the regulations required to be written by Dodd-Frank have so far been written and put into effect. That's 40% after 2.5 years. The derivative plans, the Volcker rule, have all been delayed until next summer. So it's hard to know exactly when all of these rules will surface, but it's certainly taken a long time to get to where we are. The derivatives rules are also unclear at this stage, but one analyst group, Sanford Bernstein, has estimated essentially that the derivatives, which make up approximately 15% of net income revenues and 20% of institutional net equity revenues, they think that 70% of the notional amount of these outstanding derivatives are generic contracts that can be moved on to a central clearing venue and be treated through some kind of swap execution facility. This portion of the business presently produces about 50% of the profits, but once it's put onto a central clearing venue, we think that both margins will go up and transparency will increase and the spreads will reduce. So the profits from derivatives will decline from somewhere in the neighborhood of 35% pre-tax margin to 24%. Now here's another poll question. We'll stop here and take this. The actions of government to control systemic risk in the future have been A, appropriate and are likely to be successful, B, excessive and are likely to constrain innovation and efficiency in financial markets, and C, they are insufficient and are likely to result in dangerous levels of systemic risk accumulating in the future.
I'm going to give you a few seconds to read those over because the answers are truncated on my once I launch.
You want me to read it again?
Sure. Go ahead and read them one more time, and then I'll launch it.
Okay. Do you believe that the actions of governments to control systemic risk in the future have been appropriate and likely to succeed, or excessive and are likely to constrain innovation and efficiency in markets, or they have been insufficient and are likely to result in dangerous levels of systemic risk accumulating in the future?
Okay, I'm going to launch it now. You have 10 seconds to answer. I have closed the poll. I will share the results with everyone. We had 21% said A, 37% said B, and 42% said C.
Well, in my view, they're all right. They've probably been as appropriate as they could be under the political constraints of the governments that they operate in. And on the whole, they are weighted heavily to stop the kind of systemic risk accumulating in the very large banks. But in order for this to work, they have to be implemented and enforced and controlled successfully, which maybe they will be, but the past record would suggest that that might be hard to do. Many people believe that these are going to be extremely expensive forms of regulation that will, on the whole, contain innovation and such, but on the other hand, that means that the markets have to adjust to it in some way. There are still people, in this case the majority or the largest number of you believe that these things still do not address systemic risk in such a way that we can be confident that we will not have any major financial collapses in the future. And I think that's also right, but in this case we're probably talking about getting at least 10 years before we get into the business where we sort of lost control of whatever it is that we thought we put together in the first place. Now, let's move on. The banks today face three important challenges. First is the prolonged cyclical downturn. The Great Recession is continuing, and we are still finding that the new issue in M&A operating markets are at about 60% of pre-crisis capacity, and the profit margins have decreased as the firms have competed more strenuously for what business there is. Trading profits are down as well for the same reasons. Structural changes are coming. We've already adapted to some of them by increasing Basel III capitalization rates, but there are more to come that haven't got here yet. And some of the implementation schedules still lie ahead. And when we see what these all are, they're unlikely to make things easier and looser, much more likely to be strict and more constraining. And then there is the question of what about the reputational damage that has been done to these large banks. Good reputations provide banks with easy access and influence over counterparties, government officials, policymakers, and clients too. But a loss of trust means that clients and all the government officials and counterparties in the markets are much more wary and reluctant to just trade with you without being especially careful and maybe negotiating, maybe looking for somebody else to offer you a different deal. And of course, the banks are involved in a strenuous effort to settle regulatory and other litigation that's been going on for several years, but seems to be continuing to go on. Now, at the bottom of the cycle, as I just said, the capital markets are below the peak volume. We've just seen a report yesterday from the Eurozone showing that in Europe, bank loans are down about 40% this year compared to what syndicated bank loans, compared to what they were before. But corporate bond issues are up about 40%. So this is suggesting that when the banks are deleveraging still, struggling to raise their capital, they don't want their transactions on the balance sheets, and so instead they're selling them off into the markets. This suggests that the banks have a lot of distribution capacity that they can use, and that as far as the issuers are concerned, they're somewhat indifferent as to whether they're selling a 5-year bond or a 5-year bank loan. But this is suggesting that the bond markets, attracted by very low interest rates, are continuing to do a record volume. However, one part of the bond market is still very stagnant, and that's the mortgage-backed securities sector, which accounted for, as much as 25% of it in its better days, and now it's hardly any. So that sector has to be rebuilt in order to regain some of the levels that the banks were operating at before. But the turnover in trading volume is also down, and we have had volatility spikes which have put a risk-on, risk-off trading conditions into the market, which make it tough for traders. And we've seen a number of trading losses or disappointing results from the trading efforts that have been undertaken. In the midst of all this, extensive layoffs and cost cutting are going on, and this often means that banks get to the point where they cut into the muscle, not just the fat. And some of the people that have been discontinued or departments that have been aggregated have lost some of their risk control capacity and so forth. But it also may mean they've lost some of their ability to be able to bounce back with transactional activity when the markets do turn around. This is a chart from AllianceBernstein that shows the trading, the return on equity of the capital markets industry based on the green line here is fixed income trading and the black is equity trading. You can see in this case, both of them are well below their required return on equity capital. Leverage has declined, risk-taking has been more cautious, but the returns simply aren't there under this environment. Now, another factor that's occurred is that the banks have to pay more to borrow money than they did before. If you go back to the period in 2007, when all of these major banks were basically regarded as too big to fail and would be supported by governments, you can see that the spread over the best quality paper was basically nothing. But during the spike, some of the worst banks went way up into the sky, but the spike periods stayed from the fourth quarter of 2008 until through the first quarter of 2009. Then they got a little better with all that government involvement, but it's come back again. You see, starting with the fears in Europe and with the prospects of more difficult capital market activity, the spread between banks like Morgan Stanley, Citigroup, and Bank of America, and down here, J.P. Morgan and Goldman Sachs are quite considerable. There's now about 150 basis points difference between the best and the worst, so to speak, of these banks in the market. Now, these are rates at which banks have to borrow money in order to on-lend or to invest in trading positions, and they ultimately have to compete with each other, so a high cost of funding relative to another could be a very serious competitive disadvantage. This has showed up in a recent downgrading by Moody's of all of the major capital market banks. Here are just the top 10 or so that I've picked out. But we now have 3 tiers according to Moody's. Now, Moody's talks about holding company levels. So we have JP Morgan, Royal Bank of Canada, and HSBC, a holding company level of AA3 or A2. Middle tier, holding company A2 or A3. And then the bottom tier is down to Baa1 or 2. That's Bank of America, Citi, and Morgan Stanley. Now, they've also come out with something called a standalone rating, which means that there is no assumption of any kind of government support whatsoever, and no ability to borrow from within the holding company from one regulated entity to another. And you can see that these guys drop from AA3 to A3. The middle tier drops from A2 or 3 to Baa1. And in the case of the standalone ratings of Baa3 of these 3 guys at the bottom tier, these are basic credit ratings which are only 1 notch ahead of a junk bond. And it's very hard to be a major bank with a almost junk bond credit rating and expect to be able to compete with others. Needless to say, the stock prices at the bottom of this cycle have been very rough too on the banks, but they've been very unevenly rough in the U.S. The orange one here is Citigroup, down at the bottom about 90%. It seems to have hit the bottom and stayed there. Bank of America has enjoyed a rally this year, a considerable rally, which has lifted it up to just about only minus 75%. Morgan Stanley isn't much better. Here's Goldman Sachs in the middle and JP Morgan, which is trading almost at the same level it was 5 years ago, suggesting that the best of us going through this crisis are as good as we were 5 years ago, in which investors got 0 return. Well, that's better than all these big negative returns. Whereas in Europe, all these banks, the 4 principal banks have been essentially the same. We had Credit Suisse was doing better than the others for a while, but it's all down to actually 1 small point here, where they're somewhere around 60, minus 60%, but they're all clustered together. All of the banks, however, are suffering from the standpoint of returns to their shareholders and creating other problems. This is a chart that I prepare every quarter, which shows it's an effort to calculate the economic value added produced by these banks during the period. This is year to date, so it's 9 months year to date. Economic value added is the return on equity minus the cost of equity capital. And we see the cost of capital here, the return on equity over here, but the shocking thing is that the average is minus 8.7%. And it's as high as serious double digits for 1, 2, 3, 4, 5 of the top 10 players by market share. Now, the best ones are here is JP Morgan with a plus number, but the rest are all minus. But they're minus by relatively small amounts, except for Deutsche, which is minus 8. Credit Suisse, minus 6. But the average for the bottom 5 is minus 13%. And the average for the top 5 would be minus 3%. Again, that's a 10% difference in terms of the economic value added of these entities going forward. This number has been negative for at least 3 years, and it's actually more negative now than it was at the beginning of 2 years ago. It's also showing us that even after a rally in the last quarter, the market to book value of these banks is still pretty bad. The average is 63% of book value. It's as bad in some cases. Bank of America, 43 cents on the dollar. Deutsche Bank, 51 cents. Barclays, 50 cents, and so on. So you can see that these do make a significant difference. These banks are showing that they're trading well below book value, and they have very negative economic value added. The banks actually have a real question as to the viability of their business model going forward. The structural fears that we are still fearing, the ones we haven't dealt with exactly, are what will the leverage and liquidity restrictions be when they are announced, and how much more will they reduce the return on equity? And these things are going to be increasingly potent between now and 2019, so they're going to have increasingly constraining effects on ROE until that time. And this essentially means that the basic economics of a business model called either the fortress balance sheet or a flow trading monster are now in doubt. Flow traders, which are trying to see the flows all over the world, trying to accommodate market as market makers in large trades, but you position your own trades ahead of the market changes you think are coming. There's some question about whether these firms will be able to operate in that business in the future. The restrictions imposed by Volcker rule and the movement to derivatives are as yet unknown, but and the impact will probably be leaking out over some period of time, 3 to 5 years, which could be, meaning that this could go through a period of continued uncertainty that people are going to have a hard time reacting to. Some, because of regulatory actions by the Swiss and the British, may be unable to sustain major capital market activity in the future. The Swiss have made it required that these two Swiss banks have to hold about 20% of their risk-adjusted assets in capital. That's more than they're required to do elsewhere. UBS has already announced a strategy change that is essentially going to emasculate its market-making and trading activities, essentially exiting those businesses. Credit Suisse, which is a smaller enterprise, hasn't announced yet what it's going to do, but at best it'll have to melt it back in order to comply with the Swiss rules. Barclays will have to deal with the Vickers Commission, which is going to be probably put into effect next year, in which the domestic business of Barclays will be ring-fenced inside the UK, entitled to government support, but it'll have to maintain a 10% Tier 1 ratio. But everything else will be considered outside the ring fence and not be given any assurances of support from either the government or the rest of Barclays. That means that the Barclays capital business would have to be sustaining on a completely standalone business, which would knock it down to a questionable bond rating. Now, we also see systemically important investment banks may be forced more into public utility roles than they have played in the last 30 years, because the regulatory surveillance and enforcement is going to be acute. Non-systemic banks and non-banks will have the real profitability advantages because they're simply going to be exempted from a lot of these rules. So that means hedge funds, private equity groups, new outfits to be formed, and such that manage to keep themselves outside of this systemically important label will do much better. And that, of course, suggests that talent may be flowing from one of these areas to the other. Why would great traders or quant fellows or others who are have been aggressively employed by these banks in trading roles want to stay there when they can move to other places that might be better? Now, the reputations are simply end with this by saying that the public sees the banks as greedy predators responsible for the crisis, so they continue to see exposure to conflicts of interest, continue to see them involved in recurring lawsuits that seem to be endless. I mean, the UBS is about to sign on to a $400 or $500 million settlement for its contributions to the LIBOR rigging, and there'll be other guys that come along as well. We think the industry as a whole may have to pay out $50 billion before it's over in just these kinds of lawsuits, most of which are in the U.S. But it also creates a loss of access to and the trust of governments and clients, and where that real trust runs is to whether these banks have become too big and complex to manage. That being the case, they tend to shun them. Here is a list of the settlements so far. The robo-signing in the U.S., the Fannie Mae and other mortgage-backed put-back suits, the SEC and other securities infractions, market rigging, and so on. So the alternatives at this stage are to see some banks do radical exiting from the former business model. Active trading in capital-intense positions, we can see some of these already moving in that direction. All of these banks have had management changes. The new management are not traders, they're not investment bankers. They're trying to bring things back to some sort of more normal level. UBS has already announced a major change. These others, we might expect to see them soon. Or they could get out of investment banking altogether, as American Express did when it sold a part of Lehman Brothers and spun off the rest in 1993 in a successful effort that recreated Lehman Brothers. At that point, maybe it's possible for Barclays to do the same and have the third reinvention of Lehman Brothers occur sometime. More likely, we'll see banks trying to adjust existing models to optimize trading, increase the distribution efforts rather than the retention of assets, and all of these firms are likely to be the ones most committed to continue to do that. J.P. Morgan, Goldman Sachs, Morgan Stanley, Credit Suisse, and Deutsche Bank. Some are going to have to minimize the platform complexity of their organizations and improve manageability by very large amounts. Citigroup and Bank of America are in great doubt as to whether they can manage the stuff that they've got, although Citigroup has already committed itself to breaking it into two parts, a so-called good bank, the Citicorp unit, and the rest of it called Citi Holdings, which is almost now fully wound down. And there'll have to be a lot of engineering, re-engineering businesses to be able to achieve higher ROEs. Some kind of successor to flow trading models will probably appear for those firms that continue to be firmly committed to that. Now, they also have to send out a new message for their investors. In the past, these big banks have said, we can grow at 15% a year, and we can make a 15 or more % return on equity. We're growth stocks, pay a high multiple for us, we're where you want to be. That message no longer is believable by any investors, which are expecting less growth, lower returns, less risk because of these systemic constraints, and fewer legal problems in the future. They would like to think that this can relate to a more reliable income stream, higher dividends, and a little more peaceful approach. In the end, we could see these banks going back to the kind of large models that they were in the 1960s, surrounded by a whole bunch of non-systemic investment bank types, such as we had in the 60s then. So the new ecology of capital markets is likely to see systemically important surviving players, J.P. Morgan, Goldman, Morgan Stanley, Credit Suisse, and Deutsche Bank, increasing their market shares as they come back. Some new challengers coming in, the HSBC, Royal Bank of Canada, and Wells Fargo possibly, and some non-banks getting in there. GE Capital, Berkshire Hathaway, AIG are some big names that come to mind. But a lot of activity is being revved up in the smaller investment banks and boutiques, the private equity and hedge fund groups down here, and on the whole, this industry is probably going to reposition itself for more opportunities that involve innovation, aggressiveness, and maybe some risk transfers. So let's have the final poll question. My presentation is pretty much over now, except for a few questions, I hope. The final poll question is this. Capital markets have gone through difficult periods of adjustment before. This time, A, there's likely to be a major shakeup in the top 10 capital market league tables. B, a small number of large, safe public utility banks will dominate ordinary capital market business, and a large number of smaller, old-style investment banks will provide innovation and risk distribution. And 3, market shares will remain much as they are now. There won't be all that much of an adjustment. It will just be weathering the storms and coming out as we are because of the entrenched commitment they already have. So I'll let you poll these 3.
Okay, I'm going to give you just a second to look them over, and then I'm going to launch. They are truncated again. I'm going to launch it now. You have 10 seconds to answer. I have closed the poll. I will share the results. We have 24% said A, 44% said B, and 32% said C.
Well, I agree with that. You can't be sure how it's going to be, but I think that B is the most likely outcome. But that's a fairly dramatic change, and it will probably take several years for it to be visible. In the beginning, it will seem like market shares remain much as they are now. After 5 years, the market shares have changed very little from what they were before. But we do see some institutional stress that's going to reduce the shares of some of these players, and therefore a major shakeup in the top 10 capital markets may occur. I'm not so sure that the top 5 are going to suffer so much. So it's probably in the second 5 and maybe the next 10. But in the end, I believe that if the regulators can do their job, which was to impose sensible systemic risk reduction rules, enforce them wisely and effectively, and basically let some of the rest of the stuff go away, then there's a very good chance that we'll go back to a very large, safe and sound banks surrounded by a whole bunch of barracudas swimming in the moat, doing the old-style risky stuff that bankers used to do when I joined Goldman Sachs in the 60s. So with that, maybe we have time for a question or two.
Sure. Professor, thank you very much for the detailed expose on where you see the industry going. It's been great to have someone with your practical experience and your academic discipline to put things in perspective for us. And by the way, let me once again praise the faculty of NYU. They're all great, from theoretically savvy Nobel laureates to people with a wealth of experience like Roy. Let's go to the regulatory aspect here, and I've just attended the roundtable. It seems that the mapping process is hard even for the big players. How is it going to reduce our too big to fail or too big to manage problem when the little banks won't have the compliance resources? You think we're going to see
the basic idea is that smaller banks can fail. And if they do, they won't create a risk to the system. Indeed, during the recent financial crisis, we had a great many hedge funds and smaller financial enterprises fail or virtually fail. Many were taken over in mergers, but a lot of them did fail. And nobody knows because we were too busy with the big ones. So the idea is that if we transfer systemic risk outside of the fortresses that are safe and sound to a greater degree than was there before, to the wider universe of tens of thousands of risk-taking non-systemic banks, it doesn't matter whether we regulate them as well as we regulate the others, because if they fail, they fail. It doesn't matter.
I wholly agree with you, but what do you think about the regional banks? Are they going to see some regulatory relief compared to
they certainly hope so. The regional banks hope so, because at the moment, Dodd-Frank is for them largely irrelevant in the sense that a lot of the things that Dodd-Frank wants to regulate, they don't actually do or do very much of. But the cost imposition on them is huge because they have to report that they don't do all these things. And I believe they deserve relief, and I think they will ultimately get it because it's rational to think that they should. But it does depend on whether these regional banks, when they recover, that is, when we get out of the downturn and we're back into normal business conditions, are they going to start merging with each other again and create systemically important players that, you have to make some allowances for the fact that the future may include some of them trying to get back in the game, and that they'll have to be regulated properly if they do.
Right. What do you think are the effects that will have most concern for most Eurozone and Asian banks? Is that something you've been following?
What are the regulatory effects that come from Europe and America that might wash onto the Asian banks? Is that the question?
Let me rephrase it. So within the Basel III framework, what do you think are the most important amendments, most important effects that will come over to the banking industry in the Euro area and Asia?
Well, the Euro area has the full exposure to Basel III as it is. So they have to adjust their risk-weighted assets and the amount of capital and the liquidity reserve and so on. They have to do that the same as the Americans do. Some of the Asian banks may not be covered by Basel III or any of the Basel agreements, and there is a question about Chinese banks as how they would look if they were put into a really fiercely administered program for judging risk-weighted assets and capital adequacy and so on. All I can say is that I believe the idea of the Basel Agreement is that all of the big banks in the world, including the Japanese and Chinese banks, that operate in the global financial system, that is to say beyond their national systems, would have to be compliant with all of these things, and that could be a big problem for Chinese and some other Asian banks. I think the Japanese banks probably are going to be able to comply all right, but I really don't know enough. I don't know how the Chinese banks will fare. That information isn't available to us.
Indeed, we need more transparency there. And
well, there isn't much of it at the moment. The Chinese banks are operating largely as domestic entities. And when they start to get into the international businesses more, in which case they start participating in international risk, then all of their trading, all the other countries are going to want them to be part of Basel because they can, assure us that they are subject to the same regulations of minimum risk-adjusted capital as all the other banks do.
Right. You've mentioned in your presentation that a lot of banks trade very close to half book value, and there are a lot of people who would indicate that maybe transparency plays a role there. Would you agree or disagree?
Well, actually, none of the banks are very transparent. At least these large-scale, complex institutions that we call the global banks are not very transparent, and their accounting is a real nightmare. Just think, every quarter they announce what their interest rate spread is. They announce their non-lending fees and other trading profits and so on, and then they get to the so-called bottom line, but the bottom line is attacked by an accounting adjustment, by any write-offs of anything else that's taken place, lawsuits, all this other stuff. Some of these are quite big, and some of these banks are beginning to report themselves on an adjusted basis, in which they take out all the stuff that they don't think of as recurring. The difficulty is that for all these banks, this stuff recurs in one form or another all the time. So our figures on the economic value added show return on equity calculated on a bottom line basis. This is the accounting standard that's used after all the stuff that goes through it. Now, I would say that we still don't know how much risk is in the bank because the bank gets to allocate a certain amount of its, to loan loss reserve. But this is a discretionary item available to managers to do. They also decide whether certain assets are subject to mark-to-market accounting or they're not. And so they have a lot of discretion to kind of make these things look like what they are. So I would certainly not say that Western bank accounting is transparent. The fact that some other areas have equal lack of transparency or lack of transparency for different reasons, is a different issue. But transparency is hard to judge. But it may be because nobody really knows what's going on inside these banks, that stock market investors are not prepared to pay a full price for a share of the company. But you have to ask yourself, if these guys aren't returning on equity, a return equal to pay for the cost of the equity capital they took on, then you wouldn't want to pay a full amount for it. So you would only buy it if you could discount the thing below book value so as to kind of catch it back up. But it's really, I think, transparency is a factor. We don't know what goes on, therefore we can suspect the worst. And many people do. Therefore, they don't want to pay too much for the bank. But at the same time, when you know perfectly well that the economic value added is substantially negative, you're going to have to reduce the price at which you would pay it to some sizable discount from book value in order to make it worthwhile. Now, this will ultimately have to be a major task of banks to get out of this rut that they're in. And until they do, these banks are subject to attacks from boards of directors, from shareholders of hedge funds and other people who are going to challenge the management group. these are like a lot of conglomerates from the past who had market values well below the breakup values. And when we see that to happen, it's not impossible that these banks will be shaken apart, even if management doesn't want to do that with it.
That's a very great point. You've mentioned that your base case scenario would be that we're going to go back in time. We're going to see the boutiques that are going to do financial innovation, and we're going to have the large utilities to do the basic capital markets operations. Do you think we study enough financial history, and is there a risk that we're going to forget this all over again?
Well, we always forget everything, but we reinvent, not so much because somebody remembered the past as being good. We reinvent it based on what we think the necessities of the moment are. The regulatory footprint in this thing is so strong, so big, it is forcing these changes to be made. Just like Glass-Steagall forced many changes to be made in the 30s. It lasted for, 70 years or so. What I'm saying is that the concept of a large, safe and sound public utility bank, of which there might be 4 or 5 in the U.S. or fewer, out of 8,000 banks, and 4 or 5 in Europe equally, and so on. But these are banks that are not supposed to be risky, frisky banks. They're supposed to be steady eddies, and you get a stock market return that includes dividends and so on, much like you would get from the banks of the past. When I went into investment banking in 1966, I joined Goldman Sachs, which was a firm that had 400 employees. Goldman Sachs today has 35,000 employees. There were firms in 1984, when Continental Illinois Bank went bankrupt. It was the 7th largest bank in the United States, but its balance sheet was, only trivial by today's comparison. And what you've seen is an enormous increase in the size of the institutions caused by the increasing liquidity of financial markets and the ability of financial markets to become global and efficiently priced and such, that we really created a kind of monster in terms of deregulation, globalization, and so on. The market value of all securities in the world is $220 trillion today. In 1990, it was $54 trillion. So that much money into markets and trading around and competing viciously with each other is essentially an unstable situation, which is what we have been through. Now, it may be that our regulators will not be able to contain the natural flow to get back into that stuff and take the risk and create the hazards that were there before. But it may be that we'll put up sufficient barriers that there really won't be in their interest to do that. And the ones that we don't want to fail won't be incentivized to fail, and the ones that we don't care whether they fail or not will carry on the risk transferring function that we need capital markets to do, in which case we'll be back to sort of normal, back to the future.
Back to the future, I like that. Well, hope that the Darwinian process of evolution, variation, and selection will be with us.
All of you people who work in this business, I would say, the next 10 years are going to be enormously challenging and interesting, somewhat dangerous, but also filled with opportunities for you as you work through the transition into a new industry. And that's going to create a lot of opportunities for people.
Yeah. Do you think that in this new ecosystem where shadow banking is going to play a larger role, are we running the risk of having correlated failure of many smaller institutions just because they share similar strategies? And it is going to become...
Well, that hasn't happened yet. I mean, the hedge funds, for example, that failed all had different kinds of strategies and approaches. So I worry about that when we see more evidence that that's what we have to worry about. The Dodd-Frank bill requires that hedge funds register with them to get to be a certain size and report the kinds of asset classes they're investing in and how much leverage they have and things like that. So there'll be some opportunity to inspect this for correlation risk, but so far it hasn't really happened. So I guess if those guys get to be so big, all you do is simply declare them systemically important, and then they have to take themselves apart. So nobody wants to be systemically important, but you reach that threshold at some point. And when you do, you either take yourself apart or you continue, but then you evolve into more of a public utility. To me, the system may be the best that we can get out of the stuff we have to work with. It's very hard to break up giant banks. The politics are involved. We have a lot of different countries doing things that could be dysfunctional if they do things so as to encourage a kind of risk-taking in one part of the world that we discourage elsewhere. We're trying to make this a kind of uniform treatment. So far, the regulatory approach has made more sense, but it's been overloaded with excess efforts to control things that have a lot of the cost to it. And so the burden of carrying all that cost is another aspect of this. But supposedly the people who use capital markets will ultimately pay for it.
Have you looked at the contingent convertible bonds and their effects? Do you think that
yeah, I think the most interesting one was done by Barclays a couple of weeks ago, in which the trigger is a 7% Tier 1 capital ratio, which is very high compared to the 5% ratios that the Swiss did. But if that happens, the bond you bought becomes worth zero. So that is a total total write-off at a 7% rate. Those bonds were sold. 3 billion of the bonds were sold, and they were oversubscribed, but they had 600 basis points spread. And 600 basis points was about 3 times the spread of an Indonesian bond, about twice a normal junk bond rate. So it's really up there. So it's a risky thing to have. Maybe some hedge funds will buy it and try to trade it when they get a little nervous. But that's an interesting way to go. But it's all part of the business of complying with Basel III that they have to do it.
Right, but the pricing doesn't seem very attractive at all. Any
Asian... whether
Asian...
you're an investor or you're an issuer. And from their point of view, the cost of equity capital is so much higher that even this is cheaper than much better to pay 600 basis points over some low interest rate benchmark than to pay the cost of equity capital, which is double digits.
Indeed. Do you see any Asian banks emerging in the top 10 in the next secular period?
No. Asian banks, the Japanese banks were big players in the 80s, but the crisis of the 80s and 90s really burned them so badly they went back into being domestic public utilities again. I don't see them having the risk appetite to get into this business except as public utilities, which maybe they would do. But I'm not sure that without the rest of the infrastructure you need in terms of the rest of the investment banking business that they could make it into the top 10. The Chinese banks are further behind. They're big enough, but they aren't very global, and they aren't into investment banking at all. I don't see the Indian banks doing it yet either, but HSBC could be, Standard & Chartered could be, if they change their business plan to take advantage of what they think are openings in the market, they might.
Thank you very much for sharing your thoughts today, and over to you for the closing.
Thank you, Professor Smith, for sharing your expertise, and thank you to all that have joined us today. Please go to PRMIA's website at www.prmia.org to find more upcoming thought leadership webinars and information on joining PRMIA as a sustaining member to gain unlimited access to our weekly webinars. Thank you for attending this webinar.
Okay, Rob.